Welcome everyone, S-Tier Trader here. Month number 2 is officially underway on YouTube, and I'm looking to hit the market with the same momentum as month number 1. I have been requested by you guys to start discussing the logic behind my trades more, and I am going to deliver. I'm going to do just that from here on out. What I will do is reference tools from ICT's free YouTube mentorship and then compare them to my trades. I recommend you can participate by pausing the video frequently to compare what your understanding is of ICT's concepts to what I'm discussing in my trade. I think this will be greatly beneficial to you guys and will help you become a professional trader. Before we start, as always, I am completely transparent about all of my trades. Trade number 1 occurred on February 22nd in the British pound US dollar. Trade number 2 occurred on February 25th in the euro dollar. You can compare your own charts to mine by referencing the forex.com data feed on tradingview.com. If you're skeptical at all, that's totally fine. Just know that I have my personal clock listed in the bottom right-hand corner of the screen. All right, enough with that. Let's get started with trade number 1. We are starting out on the hourly chart in the cable market, otherwise known as the British pound US dollar. The price action here looks very choppy. There are no clear sell-side pools of liquidity or imbalances for price to draw to. Remember, these are the two things the algorithm is always delivering price to. What we do have in these charts is a shift in bearish market structure. I was bearish foreign currency this week. The bearish market structure shift is a billboard sign in every single one of my models that screams, "Pay attention to me, I am going to start taking out lows." Note where my take profits number 1 and number 3 are. They are just above old swing lows in the market. The nearest swing low here is my take profit number 1. Because I'm going to be away from the chart and prices being very choppy, the majority of my position will be off here. The other take profits are considered my cookies, which again are just essentially bonuses if price goes lower than what I expected. You might be asking, why is my take profit above the swing low? Shouldn't it be below the swing low? The answer to that is that I take a low-hanging fruit approach to trading. While price is drawing to the low, it doesn't always actually sweep the low and take out the sell-side liquidity. I'd rather exit just before it takes out the low and ensure that my broker fills in my order in the process. I don't need to call the high and the low in the market to be profitable. I just need to be in the meat of the move. One more analysis item before I hit play. Just like my take profit levels are below old lows, my stop level is above an old high. The reason for this stop placement is simple. We have seen a shift in bearish market structure. Price should not need to run above any highs from here on out before going lower. The algorithm has already done its job. It has paired 1-hour sell orders with buy orders. If price does in fact take out my stop, it is likely running to the big pool of buy-side liquidity above. Because my higher time frame bias is bearish though, I'm looking for trades on the short side only for the day. Let's hit play. Now this trade is a complete roller coaster in terms of price delivery. I will be going over this trade more in my ultimate guide to recording price action using OBS Part 2, as this is a prime example on why recording is just so helpful. I'm going to pause right away so that you can see my entry. Where is price trading at? Do you notice anything? Pause the video. Price is trading within a fair value gap. Recall the 3 items that we need to trade ICT's YouTube mentorship model. First, we need a higher time frame bias. We are bearish on this trade. We need a shift in market structure. We saw that on the 1-hour chart. We also need a fair value gap, and you can see this occurring right now. In fact, look at the top of the current candle's wick. It's another fair value gap. While price is likely to go lower from here, watch how it does not. Price actually runs against me a lot, nearly taking out my stop. It is extremely easy to convince yourself that you are wrong at this point in the trade and that you should close it altogether. That drawdown is immense. We must remember the logic behind our stop loss though. Our stop loss is above the high because price should not need to run any highs before going lower. We have to trust our technical analysis. We don't want our fear of our stop loss being hit to take us out of the market. If our stop loss is hit, well, then great. Our stop loss did its job. Until it does get hit, though, we stick with our analysis and let our trade continue. Now watch how price plummets lower. This is an excellent example of why we trust our technical analysis and specifically our stop loss placement. The potential fear that we experienced from price running against us is now switched to a feeling of joy, as price has nearly hit our take profit level. Well, not so fast. Watch how price actually runs right back into drawdown territory, all within the span of one 15-minute candle. It would be really easy for emotions to be ping-ponging around here. 1 minute you're offside, then you're back onside, and now you're back offside. And would you look at that, we're actually back to being onside at this point. What a roller coaster. I eventually wake up and notice the craziness that was the overnight cable market. I end up writing my game plan on the chart itself. I am going to take a partial if price doesn't hit take profit 1 before I go to work. If it does, I move my stop to break even. Price ends up banging around here and doesn't actually hit my target before I have to leave for work. Therefore, I take 75% of my position off at 20 pips profit. The remaining 25% stays on in case I get that cookie later on in the day. I then am about to walk out the door, and in classic trading fashion, price ends up running exactly to where my initial take profit 1 was only minutes after I exit the trade. That's just classic market trolling right there. One more note before I wind up this trade. In hindsight, this is a trade that I should not have taken. Yes, I was profitable. Yes, I ended up calling the low of the day in the market. However, this trade is not one I would call high probability. That 1 hour chart had very little draws on liquidity, and the market environment was sketchy at best. This is why we saw lots of drawdown in my trade, and why there was whipsaw price action everywhere during the day. This is also why price immediately reversed after I took the majority of my position. If I want to become a professional trader, I need to focus on high probability setups, not gambling on low probability. This trade worked for me this time. However, I do not want to make taking these low probability setups a habit. This trade occurs in another Forex market via the fiber this time, otherwise known as the euro dollar. Price had been in a tight consolidation, and I knew it would be looking to wipe out both sides of the consolidation's liquidity. There's going to be buy side liquidity above the consolidation and sell side liquidity below the consolidation. Notice how price had ran the highs in the consolidation first. Then it broke a swing low. This is our shift in market structure. This was also my trigger, that big billboard I talked about, that price is on its way to seek sell side liquidity. Now, what is below the sell side liquidity? What do you see? Pause the video. Below the sell side liquidity is a fair value gap. Recall from ICT's mentorship that price seeks either liquidity or imbalances. In this case, my take profit number 1 overlaps with both a liquidity pool and an imbalance. This is why I'm going to be taking 100% of my position off here. Now, this is the first trade where you'll actually see me enter on a stop order. Usually, I'm entering in on a limit order or a market order. This time, though, I'm entering on a sell stop. A sell limit order triggers when price trades at or above your order. A sell limit order is essentially selling strength. This is what you generally want to do. This is what ICT teaches us to do. Sell strength. A sell stop order triggers when price trades at or below your order. A sell stop order is essentially selling weakness. This is not how institutional traders trade. However, we can use this to our advantage sometimes. I'm an institutionally minded trader. I want to be selling strength and then buying weakness. But in this case, I change it up. If I don't know how much price is going to retrace against me before moving into my direction, I will often opt to use a sell stop as my entry. In this example, I was not sure which fair value gap price would run higher into before selling off. If you look closely, there were multiple fair value gaps that were hit during the Judas swing higher. It was late in the week and I was near my goal. This meant that rather than trying to pick a top in the market, I could instead get extra confirmation that I'm on side. This comes by way of putting a sell stop below the bullish order block. The bullish order block in this case were the last two down candles prior to the move higher. If price was bullish, which is opposite of my directional bias, it should run higher after it retraces into the bullish order block. By having my sell stop order below the bullish order block, I'm essentially anticipating it failing. If the order block fails, I now have confirmation that price is seeking sell side liquidity. Hopefully this isn't too confusing and you can rewind it to really figure out what I'm trying to say here. But essentially, price should go higher if it hits a bullish order block. If it goes lower and trades through it, well then I know that the algorithm is seeking sell side liquidity. I'm allowing myself to sell weakness in order to get additional information from the algorithm. Price eventually runs into my sell stop order, and now I am in the trade. I am now very confident that the algorithm is going to be seeking sell side liquidity below, which is where my take profit number 1 is located. If the algorithm wanted to seek that buy side liquidity, remember, it would have traded higher off the bullish order block. Price retraces a bit, and honestly, this would have been the ideal time to sell, was during that retracement, because I would be selling strength at that point. But regardless, rather than entering below the bullish order block, instead I took the lazy man's approach to trading by entering on the sell stop. There is literally nothing wrong with taking a lazy man's approach to trading, as you'll see here. After the retracement, price trades like a knife cutting through hot butter. It is just smooth and beautiful. Nothing but down close candles occur and price hits my target. This is what we call a bread and butter 20 pip trade. No cookies were needed today as my ultimate draw on liquidity was hit, which was that 15-minute sell side liquidity pool. I am now at 35 pips on the week, and I have hit my goal, 15 pips in trade number 1 and 20 in trade number 2. Let's compare these two trades together. The euro-dollar trade that was based on the 15-minute chart had a clear objective. We were aiming for that sell-side liquidity pool with that fair value gap overlap. It was beautiful. That's high probability right there. The British pound trade on the 1-hour chart had a lot more choppiness to it, and the draw wasn't so obvious. So how did price turn out in both of those trades? The euro-dollar high probability trade was quick, and it was aggressive to our target. It took it out just like that. The low probability British pound trade saw a lot more whipsaw price action, right? And which one would you rather be a part of? Would you rather be a part of that high probability trade that just saw very quick, silky, smooth price action? Or would you rather be a part of that emotional roller coaster that was the British pound? I think the answer is pretty obvious here. Give me that high probability trade all day. That's it for this week of trading. Hopefully you enjoyed me going more in depth on why I take my trades and why I place my stop and take profit locations. If you did enjoy these, please go long on the like and subscribe buttons, and feel free to leave a comment if you think there's something else you would like me to do for these trade review videos. I'm here to help you develop into a professional trader, right? We're going to be doing this together. This week, we focused on the differences between high and low probability setups, and we also learned how we can control our emotions in whipsaw markets. This is why trading psychology is so important in developing into a professional trader. I'm really excited to dive into more psychology-based topics in April. We also learned why I will occasionally use a buy stop or a sell stop to enter my orders. All right, that's all I've got for this week. Keep studying hard, everybody. You can absolutely do this. Good luck and good trading. If you want to see my first month on YouTube where I hit 137 pips, click the video on the left. If you want to learn the best way to study price action, click the video on the right. Please go long on the like and subscribe buttons. Thanks for watching.